we're going with our last session of the conference, and this is going to be on the theme Gold and Silver Market Review and Price Outlook. May I invite Mr. Srivatsava as moderator of this session. I would request Mr. Juan Carlos Artigas, Director Investment Research, World Gold Council, to join us here as a panelist. Mr. Philip Newman, Co-founder and Director Metal Focus, and Mr. Cameron Alexander, GFMS Refinitiv, as our panelists. And with that, I'm going to hand it over to Mr. Srivatsava.
Three important speakers, each one a global expert. They've traveled far and wide, one from the US, G Srivatsava, one from London and one from so they've traveled all the way to give us some very good insights. I request all of you to please sit down before I invite the first speaker, the Director Investment Research, World Gold Council, Mr. G Srivatsava.
All right, so I assume we are the only thing standing between lunch and the end of the conference, so let's try to keep this animated, and hopefully we can get some insights from this presentation. So let me begin by talking about gold. As you can imagine, as a member of the World Gold Council, we are going to be focusing primarily on gold. And what I want to do is, once the presentation begins, a few weeks ago, actually just after the end of June, we published our mid-year outlook for the gold market. Now, what I'm not going to do today is give you a forecast for the price of gold. I'm going to give you something better. I'm going to give you the tools to understand how to think about the performance of gold. We've been doing a lot of research at the World Gold Council to understand not only the drivers of gold, but how these interact and how these change over time. It's not the same to think about the gold price in the short term than it is to think about the gold price in the longer term. So when you're looking 1 year, 2 years, 5 years forward, the dynamics change. And I'm going to explain to you why that is. This slide summarizes what we call the dual nature of gold. And this thing has been coming up quite a bit here in the conference, the dual nature of gold, the aspect of jewelry, the aspect of investment. Perhaps to Indian investors and consumers, this seems a little bit more natural, but I can tell you that based in the US, it is not immediately apparent to institutional investors or to individual investors in the US or in Europe that gold has a dual nature. Most investors in the US and in Europe think about gold solely from the perspective of an investment. However, this dual nature of gold is actually what explains properly its performance. Without this, you cannot really fully understand how gold behaves, especially over the long term. So, again, some of you may be aware that about 60% or so of physical demand a year goes to either jewelry or technology, which, probably the surprise to no one, are positively linked to the performance of the economy. Okay? Another 30% goes to to bar and coin demand and gold-backed ETFs, which again, one of the important drivers there is going to be uncertainty. So it's a flight to quality, fear, trade. And then you also have central banks that are driven by both, because when an economy expands, they need to expand their foreign reserves, but they also need to diversify those reserves, so they are creating safety on those reserves, and it is a combination of expansion and uncertainty. Again, it is really important to understand this perspective to understand the performance of gold, especially over the long term. Now, as I was saying before, we've been doing a lot of analysis over the past couple of years in terms of the drivers of gold and trying to simplify this thing. Because sometimes when people think about gold, they think that it's very complicated, or that you cannot forecast it, or that you don't know exactly what it is. It's supposed to be doing something, and it's doing the reverse, and you're utterly confused on what is happening. Well, the reality is that, again, understanding the performance of gold through its dual nature helps you create a framework to analyze gold. And what we've come up with is the fact that there are roughly 4 drivers of gold. And you can pretty much explain the behavior of gold, whether in the short term or the long term, through these 4 drivers. The first 2 that you see on the left side of the screen are what we call strategic drivers of gold. These strategic drivers, we call them strategic because if you're an investor or a consumer that is buying gold for the long term, these 2 things are probably the things that matter most. The first one is that, as I was saying earlier, there's a positive link between economic expansion and gold. And again, this shouldn't come as a surprise. If you have more money, you're going to be spending more into jewelry, whether it is for luxury purposes or for the future, right? So positive economic expansion is positive for gold. Now, of course, that tends to impact gold's performance more over the long term than the short term, right? Then you have risk and uncertainty, and that's your source of diversification. That's when usually investors go into gold fairly strongly when there is more risk in the system, when there are more concerns about what may happen. And this is what creates the properties of diversification that gold tends to have in portfolios. And again, this is really, really important. So economic expansion is your source of long-term return. Risk and uncertainty is your source of diversification primarily. Now, there are 2 other drivers. Opportunity cost, which is primarily the level of interest rates or the direction of currency. So whether the dollar or the rupee are appreciating or depreciating against each other, or the euro or the pound, that creates an opportunity cost for investors primarily, and also momentum, right? So those are the 2 tactical drivers of gold, and we call them tactical because, again, if you're tactically adjusting your positions or if you're a tactical investor, those are the things that are going to matter more. And that's also why, in the short term, if you're focusing primarily on the direction of the dollar or the direction of interest rates, you're probably going to get right the direction of the dollar, the direction of gold or how gold is going to behave. But once you start to look into longer time horizons, understanding these other drivers is truly key, right? So looking into the gold outlook for the rest of the year and let's say over the next 12 months or so, I'm going to highlight 4 things. The first one is that financial market uncertainty, so all the trade tensions that are happening, in the US, 1 week is China, the next week is Mexico, the 3rd week is India, it's all over the place, and there's trade tensions all over the place. In addition to that, there's geopolitical risk, right? And it's not only happening in the US or in Europe or in the Middle East, it's happening everywhere. Brexit is also something that is in the minds of investors, whether they are in continental Europe or in Britain. And if you combine that with a more accommodative outlook for monetary policy, meaning that today, most likely than not, major central banks are going to be either cutting rates or expanding quantitative easing, that should be supportive of investment demand. And investment demand is quite important in terms of determining the performance of gold in the medium and to some degree the long term. The second point is that central bank demand, as part of foreign reserves, will likely remain robust. So far this year, we published our gold demand trends report for the first half just a couple of days ago, and we highlighted how actually central bank purchases have been very, very strong this year, continuing a trend that started actually about 10 years ago. So 2010 was the first year in which central banks were net full buyers, and this trend continues, both for the reason that foreign exchange reserves are expanding, but also because central banks are looking for safety and diversification. The third trend that I'm going to highlight here is that because right now we are in uncertain times, we may see more changes in terms of momentum and positioning from investors. They are trying to reassess their expectations of the economy, of the gold price, of monetary policy, and those things tend to create more volatility also in the gold price. So we may see more volatility than we may have seen, for example, in the first half or even potentially on average in 2018. And then the final trend that I want to highlight is that because of the potential of weaker economic growth, uncertainty, and higher price volatility, we may see softer consumer demand in the second half. And this also may be true in part through the temporary effect that the increase in the Indian import tax may do to Indian demand. We have actually published on that. We do think that there's going to be an effect, but we think that it's going to be primarily a temporary effect that eventually dilutes, and it's a relatively modest effect, probably about 2.5% impact on Indian consumer demand. Again, what does this mean? Well, it means that in the near term, we may see some softness in consumer demand. However, we do believe that many of the structural reforms that are happening not only in India but in China will actually support demand over the long term, as we were saying earlier in terms of the drivers of growth. So how does the outlook look like? Well, again, I think it is important to understand that especially investment demand is quite influential in price performance, and we'll probably see some of that in spite of some of the softness that we may see on consumer demand. Now, another thing to note is that you probably may have heard that about $13 trillion worth of sovereign debt are trading in negative yields, so primarily in Europe. Now, we actually have conducted an additional analysis to compute real rates, and what we have found is that 70% of sovereign debt in developed markets is trading with negative real rates, 70%. And the remaining 30% is either close to or below 1%. So basically, bonds are not particularly attractive at the moment. In addition to that, there's high valuations in stocks, and again, all this environment tends to be supportive of growth. We've also conducted an analysis that historically shows, and again, this is history, but you can use it to understand how the market has performed. Historically, during periods of negative real rates, gold's returns tend to be twice their long-term average. Again, and this is probably intuitive based on the perspectives of what we discussed before, whether it is from risk or from looser monetary policy. Finally, just to conclude my presentation, I just want to highlight goldhub.com. For those of you who may not be aware, we launched a website last year to complement gold.org, which is our main corporate website, that is focused on data and insights. So this is a free platform. The only thing you need to do is go and sign in. And when you get there, you'll be able to see a lot of information in terms of performance, demand trends, holders of gold, positioning in derivatives markets, all these drivers that I mentioned, the 4 drivers, whether it is on the short term or the long term, and in addition to tools to understand portfolio performance. So we have a portfolio backtesting tool where investors and users of this website can go in and check the performance of gold from a historical perspective. So all of our research is available there, our insights and our data, so I definitely invite you to visit it. Thank you.
May I now invite Mr. Philip Newman to present his views on the gold market. Mr. Philip is the founder and director of Panelists Focus, as you all know.
Well, thank you, and good afternoon, everyone. It's a pleasure to be here. First of all, I want to thank Foretell and IIGC for inviting Panelists Focus to speak this afternoon. Right, excellent. Okay, so what I'll be doing over the next few minutes, there'll be some overlap with the presentation you've just heard, so forgive me for that. It's really into 2 portions. Firstly, looking at some of the key highlights we saw over the first half in terms of global gold supply and demand, and then looking at the price outlook, and I will finish with an actual forecast over the next few quarters, which again will complement some of the things that JC was saying as well. So let's crack on. Yeah. So in terms of jewellery consumption, and I should really stress that the numbers that you see here from Panelists Focus, really for all the markets, is really a product of the team that we have around the world. So many of you will of course know Harshal and Chirag, who are based in Mumbai, who are covering South Asia, and the work they do here is complemented by the colleagues we have in Shanghai, Manila, Hong Kong, Istanbul, Taiwan as well. So time is against us, So I'm only going to focus on these slides in terms of India and China. Happy to address the other markets in the Q&A, or please find me afterwards. So, first half of this year, jewellery demand up 1.3%. As you can see, the key driver was India, up around 9% year on year. And that was really helped by a strong second quarter, and that is also was benefiting from the release of some pent-up demand, because the first quarter was quite weak. We had relatively stable rupee gold prices in April and May, and that was really fundamental, because in April, of course, we had Akshaya Tritiya, very strong sales. If you speak to Harshman and Chirag, their estimates is that sales on that day alone were about 20-25% higher compared to 2018. And that's really quite a fundamental reason for sales around there. Expectations leading up to 80 as well were very decent. And although sales obviously backed off in June, as prices strengthened, that wasn't enough to really offset the help we saw in the first sort of 7 to 8 weeks. You contrast that with China, where sales during April and May were actually reasonably decent. But then when we saw the prices really escalate in June, higher price volatility, and that was also a time when concerns about the trade war really escalated, and that had really quite a material impact on consumer sentiment across the mainland. And if you speak to our Shanghai office, they will tell you that we saw retail footfall really collapse in June. And that was a key reason that really sort of dragged down a quarter, which wasn't too bad up to that point. And that's one of the reasons why we had what appears to be only a sort of fairly benign growth of 1.3% for the global total. What do we see in the coin and bar market? So overall, down about 6.5% for the first half. And again, strength in India against weakness in a number of other markets as well. India was interesting. Again, we saw very decent sales for Akshaya Tritiya again. But in contrast to some other markets, as the rupee price picked up, bullish expectations meant either you saw some buying into that, but what you didn't see though was significant selling. Whereas you contrast that with China and the US, for example, where we saw probably expectations were less bullish, and this meant that we did see investors liquidating some of their coin and bar holdings into those markets. And in contrast to jewellery, where India, in a sense, offset weakness elsewhere, you can see here it was the opposite. Despite the strength in India, the weakness in China and the Middle East wasn't enough to really offset that. So when we combine that with, and sort of bring that into our view of the whole year and our estimates for 2019, I'm only going to focus on a couple of things. Firstly, jewellery, a modest rise that we expect to see for the full year. Our view for central banks may surprise, but what's important to stress is that this is a net figure. As JC said, we had very strong buying. June or Q2 was a fantastic quarter. We think of the 100 tons that Poland announced. We had buying announced from India, Uzbekistan, continued purchases from China, of course, and of course Russia. What we saw is that the Venezuelan swap agreement was unwound, and that therefore meant that we had gross sales picking up, and that offset some of the gross purchases. And that's probably the reason why we have this small decline year on year. But that shouldn't detract from the fact that we still have an exceptionally strong performance from the central bank community in terms of their purchases of gold. On the supply side, for me, really the key message is on the mine production. Recycling, no surprise of an increase there, given we have higher prices, not only in dollar terms, but a number of jurisdictions. You think about the collapse of the Turkish lira, the collapse of the Iranian rial, and recycling these markets clearly picking up. Mine production, though, that may look like a very benign performance, rising by 6 tons for the whole year. But often we hear that mine production is on a downward trend. We hear about peak gold production, which we don't really, I guess, buy into. We hear about some of the major producers that their production is declining, and that's certainly true for some of them. But what we're seeing is growth in a couple of areas. Russia, for example, continues to rise. And the other interesting area is in the artisanal and small-scale mining, be that in Africa or Central and South America, for example. And these are some of the areas which really help to drive that growth and offset weakness in other jurisdictions. Australia is another one. We think about the fact that we're seeing record Aussie gold prices, again, helping to drive production in Australia, as you would expect to see. So that really completes, I guess, sort of the whirlwind view of supply and demand. Again, I'm very happy in the Q&A to address anything in more detail that you would like to cover. So where do we see prices? The first thing is just get a sense of what the price has done and what does that really tell us, perhaps, what can we learn from this? So this is a slide updated this morning. It was quite an early start. And the reason I've taken this up back so many years is really to give you an idea of why gold has struggled. You can see the number of times it got up to around sort of the 1360s level over the past few years, and each time it got either touched that level or came close to that point. We can see the lack of commitment, the lack of belief from professional investors were selling into that, and that really helps to reinforce this negative sentiment, this negative perception towards the gold price. What's obviously very interesting now, as not only have we broken through that over the past few weeks, but we've held above that level. And it was interesting this week as well, or when we had the Fed announcement. Yes, they cut rates as everyone was expecting. Not many people, I think, were really expecting a 50-point basis cut. But what was key, of course, was the language from the Fed, that they had really toned down expectations of the path they may take in terms of reducing rates going forward. And in spite of that more cautious approach, yes, we saw gold weaken, but it held above the $1,400 level. And I think that was fairly important. And of course, with the trade war picking up again, with Trump announcing more tariff increases on China, that provided some more upward momentum to gold, as you can see on the far side there. So that's all good for now. The relationship with gold versus dollar, everyone knows about this. But the reason I wanted to highlight this is that how that dynamic has changed over the course of this year. When we were at the beginning of this year and we were forecasting or trying to forecast prices, and we were thinking about the trade war, our expectation was that the trade war would immediately be very positive for gold. And as forecasters, that didn't really help because the opposite happened. We had investors looked at the trade war, and their view was that emerging markets would be some of the biggest casualties. We combine that with the beginning of this year, expectations were that the Fed would continue raising rates. And so this combination really attracted money into the US market, strengthened the dollar, and provided a significant headwind to the gold price. We fast forward to now, that's changed. Yes, the investors may still view that the emerging markets will be casualties of that, but given now we've had this change in sentiment, this change in view by the Fed, and the fact that actually now started to reduce rates, well, and the dollar perhaps isn't viewed as the same role as the safe haven as it was before. And therefore it's now acting as less of a headwind to the gold price as well. The trouble is that, and again, we're really looking at this from the point of view of professional investors. It's really quite a mixed message that we're getting at the moment. And this is why when we come to our price forecast to the end, it may look perhaps, yes, it's positive, maybe some of you would expect to see a more positive view. And one of the reasons for those mixed messages are things like US equities. Yes, they've taken a bit of a dip in the past couple of days, but they're still trading or they're still around record highs. And so although investors may be reacting to the trade war, they are looking at other safe havens. They're looking, for example, at buying the yen, or within equities, they're looking at buying defensive stocks. So for many investors, still gold isn't on their horizon. We contrast that with some other indications that we have. This is a slide that Harsh put together. It took me a while to figure it out, so hopefully I can explain it. What this is saying, that every point in time is what market expectations were of growth, or would be of growth in 2019. So as you can see, as we move through this, as we get into 2018, the market was expecting growth this year to be very, very strong. And that, of course, transmitted itself into a very strong equities performance. As we move through into this year, you can see that expectations have weakened of what growth would be. But again, we then compare that to the slide before, that even though those expectations have got weaker, stocks were still rising. Just to reinforce this one is a view of global manufacturing in terms of the Purchase Managers Index. And again, you can see how that declining trend over 2018, and as we moved into 19, again, finally moving into negative territory. So there should be another argument why investors should be thinking about where, from a portfolio point of view, what should they be looking at in terms of safe haven. But again, I bring you back to my slide of US equities, and again, that's still at very high levels. And these are some of the, I guess these are the contrasting or opposing forces that we're seeing amongst professional investors. Now, of course, some investors have reacted to this, and we've seen this movement into treasuries. And this, I guess, is a subset of what Jason was talking about in terms of the assets in terms of negative yielding. Because when you're thinking about investing in gold, it is a chase for yield. It's a competition for yield. And if other assets are not giving you a positive yield, this, of course, should be very positive for gold. And the fact that the German bonds have moved into negative territory, and the fact that investors are so concerned that they're having to pay the German government to hold the money for them, this to me should be a sign, again, should be very positive for gold. And we think ultimately it will be. It's just taken, I think, a while to get there. And I think one of the reasons for that is that when we think about the professional investors that invest in gold, in 2008, 9, 10, when we saw gold prices ramping up, some of those got burned when gold prices fell. And I think there was that headwind or that reticence for some of those investors to come back into gold. Or if they're in gold, they have a smaller, say, footprint than they did back then as well. The reason we put this up, this is showing you investor positioning. So in spite of all of that, in spite of that reticence by many investors out there, to have a gold price of around $1,400 tells you that there is still a reasonable participation by investors in the market today. So what we're showing you here is that the blue bar is gross long positions on COMEX in New York, and the grey area is gross shorts. And there's a couple of points that we take from this. Firstly, the fact that the short position, say in July or a year ago, is now so much smaller than it is now, gives you a sense that investors are certainly feeling more positive towards gold. Cautious, that concern that, because here the longs are still quite decent, but they're really hedging their bets both ways. There is that concern. So we have a really decent gross long position at the moment. The concern I would want to share with you is that this long is now fairly elevated, and so we're now wondering how much more will this grow? Is there room for investors to significantly grow this? Because we certainly need that for further upside or material upside in the gold market. And this is one of the reasons why, although we're positive towards gold, we are still, I guess, taking a fairly cautious stance towards it. And so this is probably the slide maybe some of you wish I'd started with, but this is showing you our outlook over the next 2 or 3 quarters. The yellow bar is giving you average price over that period. I'm happy to share the presentation with anyone who would like to receive it afterwards. And then the orangey colour and the turquoise are giving you the high lows in those periods. So again, it's made us cautious because for Q3 now, we got a high of around 14.85 for Q3. That's only about $40 above where we got to over last week. And so we still think there is a lot of reticence by investors. Do they think that gold can build in this level? Many investors, we think, still need to be convinced. But we do believe that will happen, which is why this, I guess, semi-cautious upside we have for the next few quarters, we do think this will continue beyond this, and we do think that prices will continue to strengthen as we move through 2020 as well. So on that probably upbeat note, that's to conclude my comments. Thank you.
May now invite Mr. Cameron Alexander to give his views on the global silver market.
Good afternoon, ladies and gentlemen. Thank you very much. Thank you for those that have stayed around for the ultimate and last presentations of the day, for the whole conference. I'd like to reiterate Philip's comments initially as well, and to thank Foretell and the IIGC committee basically for inviting us to speak. It's a pleasure to be back here in India and to see this part of the country. Certainly a first for me, it's quite fascinating. I won't go into too much of the macro detail, as it's been well covered in the discussion so far, but I really want to touch on the main sort of fundamentals of the silver market and look at where we think the market may be going over the short term. So what we're looking to discuss today is really the main factors that it's outlined in the 2019 Silver Survey. So first, you wanted to look at last year, and the silver prices were down for across all the major currencies, with silver in the Turkish lira again the standout. A massive devaluation of the local currency saw silver prices in lira terms jump by some 21%. International trade dispute had an impact on the strength of the US dollar, and that had a downward effect on the silver prices. So the dollar fell by some 8%, while here in India, the intra-year price dipped by 5%. Looking to this year in dollar terms and on an intra-year basis, silver is up by some 7%, while the average price in the first half was 8% below where we were in 2018. In rupee terms, the intra price is 6% higher than the average, with the average price to mid-year 2% lower than where we were the previous year. So I'll move on straight on to our supply-demand balance. And total supply was down by some 3% last year, driven by a drop in mine supply, scrap, and a rise in de-hedging. Basically on par with the level we saw back in 2014. Jewellery and silverware fabrication was up 4%, accounting for 26% of the global total. Following various years of declines, finally a rise in investment demand, driven by almost exclusively by India, and that will be a topic we come back to several times, jumping by 20% for the full year. Coins and bar demand accounts for around 18% of the total demand. And this segment was up by 15% from the prior year. Industrial fabrication saw a small dip last year on the back of a solar market recording a bit of weakness, on what remains, however, still a promising outlook. So total demand was up by 4% on a year-on-year basis. Silver jewellery fabrication increased for the second year in succession, rising 4% to an estimated 6,600 tonnes. Now, India was again the standout last year, with a surge in demand in the final quarter driving consumption 16% higher than the previous year. And this was a record level. Elsewhere, demand was rather mixed, with fabrication demand in the United States recording another rise, although the pace of growth has been slowing. while in European demand slipped by 3%. And here in East Asia, demand as a block was 3% weaker, dragged lower by declines in China and also in Thailand. While this offset some growth we saw in Vietnam, in Indonesia, with these markets maturing and expanding. Global silverware fabrication increased for the second year in succession, rising 6% year on year to an estimated 1,900 tonnes, a 3-year high. And India was once again accounting for the bulk of the annual rise, increasing by some 10% and contributing to more than 2/3 of global consumption. So net physical bar purchasing was the main driver behind the rise in the retail investment figure. As you can see from the chart on the left, the increase was almost exclusively attributed to India, rising by 53% last year. North America saw continued weakness for bars as well as bullion coin fabrication. Non-bullion coin fabrication, however, recorded a stellar year, increasing by over 40%. So identifiable investments, which consists of physical bar investment, coins and metals, and additions or drawdowns to ETP holdings, rose by 5% to just over 5,000 tonnes. So in value terms, identifiable investment was approximately $2.5 billion, 8% lower than in 2017. Following a precipitous fall in 2017, coin demand eased 4% last year, dragged lower by sizable falls in Oceania and North American region. However, it should be noted that bullion coin demand has rebounded strongly this year, jumping 46% year on year in the second quarter. The largest gains seen in the United States, where demand was up by 37%, to account for 55% of the global market. And after rising by less than 1% in 2017, total holdings of silver exchange traded products, or ETPs, declined by 3% to just over 20,200 tonnes. As silver lost its investment luster due to the strong US dollar, strong US dollar. In value terms, total holdings decreased by 11% to approximately $10 billion, with both the silver price and the tonnage retreating during the year. So looking to this year, silver ETP holdings have been on the rise, jumping by 3% or 308 tonnes in the second quarter, its highest level since December 2017. Large inflows in the month of June far outweighed activity in the prior 2 months. So year to date, or to the first half of the year, inflows have only been rather moderate, up some 70 tonnes since the start of the year. But in more recent weeks, we have seen greater inflows. I touched on earlier that industrial fabrication was somewhat weaker last year, down just 1% to around 18,000 tonnes. The solar demand was the biggest driver of this decline, down some 9%, or to 2,500 tonnes approximately. The PV, or photovoltaic, or PV, continues to face ongoing thrifting and substitution pressures, with production weighted average silver loadings per cell falling 6% from the previous year. And indeed, it's fallen now by some 80% in the last decade, as fabricators look to lower their production costs. Global PV installations rose by 6% in 2018, to reach an estimated 104 gigawatt. In 2019, installations are likely to touch around 120 gigawatt, an 18% year-on-year rise, with China again being the largest contributor with close to 40 gigawatt. And looking at the chart on the right, shows the ongoing thrifting of silver in this segment over the last decades. While global installations are actually rising, the amount of silver used per cell continues to fall. Industry feedback suggests that we still have a little way to go till we reach that bottom. And the rise in installations globally should see a return to growth for silver demand in the coming years. And any potential drop in China will be offset, in our view, by the rise in Australia, Europe, and here in India, with strong incentives for extra solar capacity. One thing we have noted in the last probably 12 months is that Japan was very much the key driver of silver powder in this market, but they are losing market share quite rapidly, as the quality of the silver powder produced in China is rapidly becoming a much higher level and can be used in EV fabrication. So we're now moving on to the sort of main areas of supply. And silver mine production fell last year by around 660 tonnes, the third consecutive year-on-year fall. The decline was mainly attributable to the primary and lead zinc sectors, mainly in the Americas, as the Guatemala's High Court suspended the mining licence of its biggest operation, while maintenance problems in Canada's top producer negatively affected silver output by a combined 740 tonnes. Partially offsetting the losses, India, China and Argentina's silver production rose by a combined 275 tonnes. Argentina posted a 3% production increase, while China reported a 2% increase in silver production in relation to 2017. And over 90% of the world's third largest silver producer is sourced from base metal mines, while only 6% is obtained from primary mines. Production has bounced back somewhat from the effects of tighter environmental controls experienced in 2017. And after meeting new government requirements, lead, zinc and copper mines posted a modest recovery last year in their production numbers. And in so doing so, lifted byproduct silver production somewhat higher. After recovering from infrastructure damage caused by a fire in 2017, high grades and high utilisation in the processing plant at the Cannington mine, Australia's biggest silver producer, boosted production in 2018. We expect silver output to further increase in 2019, as operations in a high-grade phase of the mine are projected to continue. In Russia, silver production as a byproduct in gold mines in the country increased by an impressive 32% to almost 400 tonnes, offsetting the primary production deficit of some 7%. On the negative side of the ledger, production in Canada dropped by 10%, following a lower throughput through Vale's Subriet operation, while the United States is also experiencing a reduction in silver output of 17% year-on-year to a total of 870 tonnes. The largest decline in 2018 was posted in America's Silver Corporation, where several issues in its Galena operation forced the shaft to shut down for around 17 days. Peru also posted a silver production drop, declining by 2% to just over 4,500 tonnes, especially within the primary and copper sectors. So looking at the cost structure, and on a co-product accounting basis, total cash costs plus capex stood at around $10.40 an ounce, decreasing by 2% from the previous year. The main cause of the decline was an 8% reduction in capital expenditure, including sustaining and expansionary investments. Guatemala's Escobal mine remains suspended from Q2 2017, accounting for 1/3 of the decrease in silver equivalent ounces produced, while Mexico and Poland also saw declines in their capex substantially. Silver total cash costs, or net of byproduct credits, fell for the sixth consecutive year last year by 48% to negative $4.95 an ounce. This global trend is fueled by high production and byproduct credits from Poland and here in India, in addition to higher byproduct credits from Peru. However, this was partially offset by less production in Bolivia, Guatemala and China. In 2018, primary silver producers accounted for some 26% of global output, of which our cost data capture represented around 76% of primary supply. We expect the silver price to regain strength in 2019, pushing co-product costs higher, while byproduct costs are anticipated to continue to be relatively stable, as lower grades and further environmental restrictions will trigger a decline in credits. On this slide, we have the primary silver output overview. So on the top left there, we have primary silver production, a percentage of total silver produced over the last few years. So in 2018, it was down to 26% of total production. Gold was up very slightly, lead zinc too in terms of market share, accounting for 36% of the total. On the right chart, silver production from copper mines has risen the most percentage-wise over the last decade. But this is not an absolute comparison. And looking at the hedging profile last year, and the global producer hedge book contracted by around 90 tonnes, on a delta-adjusted basis, representing a 13% decline on a hedge book total compared to 2017. The hedge book stood at a total of 580 tonnes at the end of December last year. Of course, another major hurdle for silver to overcome, at least from a fundamental point of view, is a significant level of above-ground stocks, so metal sitting in vaults. Above-ground stocks plateaued in 2017 and started to fall last year, but importantly it is worth noting that current inventories can cover around 28 months of global demand. Custodian vault stocks were the main driver behind the drop, followed by ETPs. Exchange stocks witnessed a considerable rise in 2018. Of the regional split, North America accounted for the largest share of above-ground stocks, followed by Europe and then Asia. Asia witnessed the biggest drop in above-ground stocks, while America saw an increase. Stocks in Europe also were slightly weaker. So just moving on to the outlook, and I won't dwell on this for too long. I'm sure we'll probably cover it in our discussions. But it's fair to say that investors have rediscovered silver in the recent months, with net long positions on silver and COMEX jumping over 8% in 1 week to around 4,370 tonnes equivalent, the highest level since February 2019. Silver, like gold, has reacted positively since the Fed signalled a more dovish outlook for the US economy, with the likelihood of a return to looser monetary policy and encourage investors back to the market. Will the rally continue? It's very hard to say in our view, but the upside we think is somewhat limited, at least in the short term. The gold-silver ratio, which for a large, certainly in the last few months, is sitting well above 85, suggests silver has been underperforming. Silver is obviously too cheap compared to gold, or gold expensive compared to silver. And every time we've hit that sort of 80ish level in the last several years, it's always reverted back towards that 61 level over a 50-year period. So there's still potential for silver to accelerate compared to gold. The average silver price year to date stands at around $15.25 an ounce. We are expecting prices to rise in the second half of this year, albeit only moderately so. Our average price forecast for this year is $15.65 an ounce. The current trade disputes between the United States and much of the world is dragging down industrial demand, negatively impacting base metals. And silver for some time has been a casualty of this on a fundamental level. It would appear that we thought we were getting closer to an agreement between the US and China, but more recently we have seen that blow out again. And so we may not see that recovery in industrial metal prices for a bit longer yet. We thought that would lend itself to a slightly higher silver price if they came to an agreement sooner rather than later. This aside to the macro influences that Philip's already mentioned. A correction in equity markets could also see silver benefit, as would a greater geopolitical risk. Absence of any economic shocks will make it slightly difficult in our view for silver to rally too much this year. Nonetheless, we do feel that silver is undervalued and prices will creep out to 2021, with prices that year averaging well above $17 an ounce, with highs, in our view, testing $19, $19.50 that year. So with that, I think I'll leave it and hand back. Thank you very much.
Unlike the last session, so far we have not got any questions. Either mean that everybody is clear or hungry. Anyway, I'll just start some questions, like we will keep it short. JC, what I understood is there are two major factors, strategic and tactical. How do you define the current move in gold? Is it for strategic reasons that it is moving? Or is it the tactical factors which is moving gold?
It's actually both. It's both because part of the movement, a good portion of the movement, is being explained by falling interest rates. And that is within the opportunity cost driver of gold, which we consider to be more tactical. However, one of the reasons why interest rates are falling is in part because there are more risks going into the economy. There are more concerns and so on and so forth. So actually, the risks levels are increasing, and the perspectives of risk are increasing. So the point being here, and actually Philip was mentioning this, when you look at the derivatives markets tend to have quite a bit of weight in terms of determining price performance in the short term. But eventually that dies out and physical demand weighs more, right? Over the long term, eventually, that information comes along. So the point is that, yes, some of the movement and some of the positioning that you're seeing in derivatives markets, in particular in the US, where you can measure them, it's fairly high, which basically means that, again, part of it is tactical, right? But we have also seen a very consistent flow into, for example, gold-backed ETFs in both the US and Europe, in sectors that are linked to individual investors that are more sticky. They are not going to be coming in and out as quickly. There are some gold-backed ETFs that tend to fluctuate more, but there's another sector that tends to be increasing. So again, to summarize, it's a combination of both, but one of the key reasons has to do with strategic perspectives over the long-term performance of the economy, including, for example, your view that investors think that the growth rate is going to increase, or they have repriced their expectations, even if that is not shown through the stock market because people still want to get returns. It is shown through the fixed income market, where kind of like the 10-year yield is kind of like compressing and the curve is inverting and so on and so forth. And there is a view that kind of like long-term investors are concerned, even in the short term, they still want to make money.
Right. If I understand you right, there are enough reasons to believe that this rally would sustain. Am I right? Please.
Yes, I think ultimately, yes. I think in spite of the upside that we saw the past couple of days, we think that gold could consolidate around these levels, but I think that's also a positive. We do have a low of 1360, which we think is, I guess, sort of more of a defensive position, because if it does break below 1400, it could fall to those levels, but even that will, I think, still be quite a high level in terms of seeing the support that could emerge around the 1360 point. But I think, just to go into everything, the fact that we, as we're sort of, it's like repeating ourselves, but I think it's worth doing so. When you do see investors piling into bonds and you see those yields falling, when you see concerns about the trade war escalating, and if we're potentially removing this headwind of a strong dollar, or a relatively strong dollar, then to us, that I think is positive. And I think it's still the case that, yes, you've got more investors in there, because a gold price of 1400 doesn't happen in isolation. And it isn't the case that investments coming in day one and nothing in day two, that will give you a spike. Gold is around these levels because that investment continues to come into the market. But you need an argument why those investor flows will then see further upside. And that, I think, is as the economy starts to deteriorate, then perhaps we see stocks plateau, and even if we don't see an outright correction in equities, that, I think, will tell investors, yes, this is different from the weakness we saw in stocks previously. This is a different dynamic, and now it is time to think about rotating into a range of safe havens, not only gold,
Portfolio rebalancing, what you said.
Yes, and I think that does say that this will be a much more sustainable rally and have some legs to see it continue.
Right. Yes, please.
Yes, sorry, I'll just add in terms of demand. I think at the moment we've had a bit of a demand shock with the price, and I think a lot of the markets have pulled back significantly in the last month or so. The price has pushed through 1400. I think the market would be good for the market if we do stabilise for some time, if even if it's just a month or two, for consumers, particularly in the trade, to get used to this price level. And then we can move, when the price moves forward, then they appreciate that's actually a good buy opportunity. So we see demand might come back in at that point.
That's what I was just about to ask. Actually, in India, gold in Indian rupees is all-time high. In how many emerging markets is gold currently trading at all-time high?
Australia, one not stands out, and Canada as well.
I would say sterling terms, it's a record high level. Turkish lira is about there. Iranian rial,
Lots of them.
There'll be lots of markets.
Lots of them.
Yes, I mean, don't forget, there we're combining those particular examples is, distress selling. You think about Brexit that you mentioned, that's why we have the sterling price where it is.
So there is a commodity element and there is a local currency element.
That's correct. And I think you've seen different dynamics playing out. Yes, you mentioned that in India, the market has backed off as well. And I think Cam's point is absolutely correct. If prices do stabilise, consumers can get used to that. It's all about, consumers are not analysts. They're not looking at year-on-year changes. They want to know, okay, this price is stabilised and come back into the market, and they know that's a price. Because if you think about India, if you're buying jewellery for a wedding, you don't just go in over one day. You're going over a series of days, over weeks. And if you go in on day one and your budget is buying X grams, and the next day is buying 5 less, and after that 5 more, that uncertainty means, well, okay, I'm going to wait and pull back. So you need that stability, and that's quite important.
So demand at this level, as Cameron has just mentioned, could come to some kind of, it will be challenged in some countries. Maybe people will wait market to consolidate. 99%.
Absolutely. I think in June we saw that a lot of the markets fall quite sharply when the price moved that high. And initially, consumers will wait for the price to get back to where it was previously before they come back into the market. If they don't think that will occur, then they're more likely just to wait and see. If the market stabilises, then they're more likely to come back in when they're comfortable with that price level.
So this 1360, what you mentioned just a while ago, wasn't that some kind of a downside level one should expect?
I think that would certainly be a flaw, and we see that how important from a coin and bar market is in terms of that bargain hunting. And also it depends, you sort of combine that with what are your price expectations. And those price expectations or those dynamics vary a lot. So for example, the Indian retail investor tends to at the moment be quite bullish for prices, which is why when we see prices picking up, we didn't see much selling back. Whereas in the US, even in June, the selling back was really quite dramatic. So that's something I think just to be aware of. The different dynamics playing out. You can't just sort of look at this as a theory that applies the same at all markets, of course.
Okay, I want to spend some time on China. Maybe I'll start with JC. What is the official World Gold Council estimation of the official holding of gold in China? They've been buying quite a lot of gold.
Yes.
Just any numbers?
Central bank reporting has actually started to be fairly consistent and fairly transparent. For a couple of years now, China has been announcing on a monthly basis when they are buying. I mean, and there was a period where they weren't buying, but now they have resumed over the past few months. Now, I think that there's a misperception or a mix here, because what happens, and that perspective is, when you look at China, China is the largest gold producer, right? But they are still a net importer. And the question is, well, where's that demand or where's that gold going to? If you look at some of the figures of jewelry demand and Bitcoin demand, they do not necessarily match, and they create this gap.
Sir, I'm asking a very simple question. If somebody asks what is the official reserve of US, we have a number.
There is an official reserve, we have it on
What
the
is
website.
China's number?
I don't remember off the top of my head, but I know that it's about the 5th largest reserve holding, and it's actually the information you can find it on our website.
So next one which I'm asking is that US-China trade war. Philip has covered it extensively, and Cameron has also done it very well. The first half of this year in China, Philip, you have just mentioned, jewelry demand is down, coins and bars are down. And it's not going to, the trade wars are not coming down, it's escalating. Where do you see the impact of this on the overall gold market?
I think you're absolutely right in terms of we did see a palpable change. It was June when it really changed quite dramatically. Otherwise, we could have been in positive territory for the Chinese gold demand for Q2. That's quite likely. So I think from an outlook point of view, if you're looking at the jewellery markets, you have to think about it. Okay, so if the trade war was to really escalate, and if everything we say comes to fruition, the first point is that can be positive for gold prices. Then it depends on how those gold prices move. Is it a steady rise or is it volatile? Then which goes to what Cam was saying about the stability. If it's a volatile upward move, then that could really undermine jewellery demand in the price-sensitive markets in India and China. So it depends on how prices move up. If it's a relatively steady move, then consumers can adjust, and then we can see demand perhaps relatively robust. However, of course, is in China specifically, given we've seen growth slowing, if you combine that with the fact that sentiment appears to have weakened, then that could see demand back off a little bit. But as you saw from our view, we still think that globally jewellery demand at this point in time is going to be slightly higher in 19 versus 18, globally speaking.
I can understand that when we have a similar view in terms of jewellery demand globally up to, I think, 2% per hour. But the other issue in China, I think, is if with the trade war ongoing, is that you might see further weakening of the currency in terms of yuan. And that if we see gold prices move higher, that will exacerbate the local gold price, which may even have a further negative impact on the jewellery side. But if we see further weakness in yuan, we may see investment demand actually pick up because the consumers will start to look for a safer haven. We've seen that to a certain extent where consumers are willing to buy into the gold rally if they're looking to protect their asset.
I'll come back to JC once again, the portfolio rebalancing which Philip mentioned. As you rightly pointed out, the US stock markets are near very high levels, close to all-time high as well. Amongst the US investors, is this motive of portfolio balancing or rebalancing a very strong motive? Is gold coming in the radar when we talk about this portfolio rebalancing?
Look, all in all, gold is still a small percentage of global assets. In particular in the US, though, what we have seen over the past couple of years is that there's more interest from institutional investors, in particular pension funds, endowments, foundations, long-term asset managers that are looking into gold. Again, and this is very consistent perspectives and more investors, some that we have been talking for years, and now they're saying, well, now I'm kind of like really thinking about, looking into the asset class. So it's certainly shifting. In the institutional space, gold allocations remain small.
So among the pension funds or these long-term funds, do you see the proportion of allocation to gold increasing?
Yeah, actually, and there have been some surveys that indicate that it's not only our, perhaps qualitative perspective. Quantitatively, you have seen investors saying we're intending to increase allocations, and you have seen a little bit of that shift indeed, happening.
And is there any recommendation from World Gold Council side, for an investor, what should be this allocation into gold?
Yeah, we do. In particular, we have actually done a lot of research into how much gold to hold. For US investors, usually that range is between 2 and 10%. We actually are conducting analysis in India, right, for Indian investors in Indian rupee. The challenge there is that the data doesn't go back as far, right? So you are a little bit limited on that. But so far, the analysis we're conducting, we're hoping to make it available through Gold Hub in months to come, is that actually the allocation for the typical Indian portfolio is probably going to be between 8 and 10%. So it's slightly higher in part because you have more exposure to the bond market, and also the stock market tends to be a little bit more volatile.
Philip, any quick comment on this central bank buying? Do you see this trend continuing beyond 2019? And is it only a few set of countries buying because of some specific reason, or a broad-based buying from the central bank?
I think one of the things that we've seen over the past couple of years, and that's certainly to continue this year, is that the number of banks buying has certainly increased. I think if you go back a few years, it was dominated by the likes of Russia and China, and I think it's become quite increasingly high profile. Only just a few weeks ago, we had the announcement by Poland of its purchase of 100 tons. We had Uzbekistan, India, of course, has returned to the table, which is exceptionally important. And the list is certainly goes beyond that. We think of Turkey as well. And then there are a number of reasons for that, whether it's to get around sanctions, whether it's to think about the portfolio allocation, whether it's thinking about, and some of it of course isn't just purchases, but it's the repatriation, which doesn't feed into those numbers, but it shows you that the banks are thinking about it in a more active way. And that's also, I think, is an important element. So we see it continuing, and although we had a pretty high gross sale this year, which I mentioned was because of Venezuela, that's fairly isolated. We haven't seen indications of banks looking to move into the market on the sales side. So I think on a net basis, going forward, central banks will remain very comfortably on the demand side.
I would only just add that we probably won't see the record levels we saw last year. I think we're in the same view that we'll see a slight reduction this year in net purchasing.
Any numbers you can put? 615 was last year.
I think for us, it was, I have to think, we are looking at it comfortably north of 500, but probably higher than that. I mean, I think even if we see it, even if we had a decline in 2020 versus 19 in terms of the central bank demand number, that will miss a point. The point is, in absolute terms, it's a chunky figure, and I think that's the key issue.
And it will be the 10th consecutive year on net purchases. If the central banks continue at this level, it's the 10th consecutive year. So it's not only that the figure, it's the trend.
Okay, just in that point, has some of the countries which have sold in the early part of 21st century come back and buy? That would be very interesting. EU members which are selling 450 tons earlier, where they're like,
So I think if you think about some of the sellers, and I'm going to miss quite a few now, but if we think about the early 2000s, so let's go, we had the first central bank gold agreement, or the second CBGA, that of course was the Europeans, and I'm not aware, so you think of those that were selling, the UK of course really stands out, Belgium, Netherlands, I'm not aware of any of those, but to go on record and say none have come back in, certainly I wouldn't say that. But we didn't have really, I think probably very few have come back into the market, I would say, at this point in time. But I'll need to check my databases.
Because that could give a very, very different flow in terms of not only direction and flow, but people's conviction on gold itself. Thank you so much. And one or a couple of questions on silver before we close it. If I understand you correctly, silver upside is there, but it has to wait. Am I right?
I think it's going to be dictated somewhat by movements in gold. And our view, similar to Metals Focus, is that we think gold prices will be well supported and will move higher over the next couple of years. And I think silver prices will also move in the same direction. I think in the silver's favour, it's obviously quite often more volatile than gold, and so we could see a higher upside to silver. On the fundamental point of view, I think it is being held back by the fact that it's, certainly the last 12 months, it's been viewed very much as an industrial metal rather than a precious metal to some extent. And the trade dispute has certainly dragged down the base metal complex, and silver has been sort of anchored, if you like.
So more of a base metal play rather than a precious metal play?
I think so, very much so.
So two things which I get it is that the base price of silver is more or less set. We could see a moderate rise, but there may be more volatility, right?
Well, I think if precious metal investors, if the investment market come back into silver and to start looking at it as more, if we see a much more tighter correlation with gold, then we could silver prices actually move higher. So under that scenario, as well as some agreement on the trade war situation, silver could see further upside. We do. I think there is scope for silver to hit $19, $20 an ounce, but in our view, it's probably a bit further down the track than the next 12 months.
And this ratio play, because India is very fond of this gold-silver ratio. So any caution on that gold-silver ratio? It has not seemed to be working in the short term.
I'm happy to, yeah. Look, I think it's looking at using it as an investment tool with silver ratio sitting above 85 and touching on 92 this year for some time. The expectation is that at some point it's going to come down and silver prices may rally. Certainly in the last 12 months, it seems to be a less clearer signal of where the market is going.
I just want to add something to that. Look, there's no fundamental reason why there needs to be a ratio between gold and silver. Like, when there was a bimetal standard in the 1560s or something, there was a clear connection between those two. The dynamics in demand and supply in the market are different. Now, of course, as with everything in investment, if people believe that the ratio matters because they start to move towards that, right? So it's a purely tactical thing, right? But from a fundamental perspective, you have a market that has some similarities, but as Ken was saying, it's also different. I mean, it's also, there's far more industrial demand in silver than it is in gold, and of course it's going to behave different.
Yes. So I think that although the ratio has come down from the low 90s, as you mentioned, and some investors will look at that and say, well, the long-term ratio is in the 60s, therefore that's a reason for it to come down. For our point of view, no. There's got to be a fundamental reason why the ratio would come down. And I think key to that, in terms of silver outperforming, is the macro backdrop. So the trade war you mentioned is a drag, but if we get past that, then if then silver starts behaving as a precious metal, then it can start moving up. Weighing on that slightly is the fact that you do have such significant stocks. Your stocks are identifiable about 47,000 tons globally. So that will, I think, provide a bit of a drag, but if the macro backdrop becomes more supportive, then we can start to see silver moving a bit higher, and then that would, of course, bring the ratio down.
Thank you. One question I'll take. What's the difference between gold.org and Gold Hub?
Simple answer, gold.org is our corporate website. Within gold.org, you will find Gold Hub. Gold Hub is our source of data and information. So that's where all of our data and insights are, which you can access directly through Gold Hub or through gold.org.
Before I close, from both of you, Cameron and Phil, of course you can also join if you have any specific directional view on both gold and silver.
I would say for gold, our view is that we are bullish for gold. We think prices can be well supported over the next 12 to 18 months. Phil certainly touched on that in detail in terms of the macro drivers. I think absolutely agree with where they're suggesting.
Just a number. It's a forecast.
One number. As
A set of numbers also.
Okay, we're at the moment average 1350 this year. I think we could see $1,500 taken out this year for gold.
This year?
1,500 potentially. It may well come back, but we think we could touch 1,500. For silver, I think we may. I don't think we're going to see a huge amount of movement in the silver price. I think we could see maybe 1,750 taken out for silver. Not really. But we have a 1665 average. So 1565 average for silver.
On the lower side for silver?
I think we could get back to sort of 1550, 1540.
1550 to 17 is what you're looking at. That's for silver. Thank you. Phil.
Karen stole my thunder on gold, but I'm still going to. So we have a high, probably above 1,500 this year, or around 1,500, continue to strengthen beyond that in 2020. But as I said, it won't be a straight line up to that. And we'll see, I think, because investors are reticent, we could see prices back off. That's a high. For silver, because it is such a small market.
For gold, what's the low you see? Currently it's 1440.
I think so the low we said for Q3 is around 1360. And I think we've already seen the lows for this year anyway. So we are on an uptrend. And for silver, because it's so volatile, you can move $1 in a day. That's always a challenge for silver. So you could see it really breaking out beyond $18. That's our quite bullish view for this year. Very exciting.
On the lower side for silver?
Again, I think we've already, probably seen those lows already. So again, we are seeing that moving up, but incredibly significant volatility, especially if gold starts to get some legs, some momentum.
JC, are you allowed to provide market views?
No, but as I mentioned before, I think that our perspective is more on the demand and supply drivers of gold.
But you're overall positive.
Well, as I mentioned, investment demand is probably going to be supported. However, we may see some softening on consumer demand.
Excellent. On this positive note, ladies and gentlemen, please give a big round of applause. Thank you so much.
And thank you so much, Mr. Srivatsava, for moderating that session, and of course, all our panelists for their valuable insight they shared with us about future forecasts and trends on gold and silver market. And at this moment, we quickly have our felicitation ceremony. I would request Mr. Srivatsava to kindly present a memento to Mr. Juan Carlos Artigas. And memento to Mr. Philip Newman. And many thanks to Mr. Cameron, since we already felicitated him yesterday, but your presence is equally important for us. Thank you.